So, I have the lucky distinction of having to come to your session every year. And the advantage is that if you come to your session every year, you have the chance to give a recommendation each year. And, in 2017, it was just a few months after Demon. And it was a year where actually markets were attractive because it was just after Demon, and it gave you the opportunity to actually invest immediately. So we recommended at that point of time, we recommended investing in multi-cap strategies and asset allocation at that point of time. And it was a call which kind of worked very well for the next 1 year. What was interesting from both Sunil stock and Vetri stock was that, finally, if people invest for 10 years passively, I think they will have a very good experience. But the reality is people don't invest for 10 years. And if people did invest for 10 years, like Sunil mentioned, you can invest wherever you want and in the equity market and get a very good experience. But the problem is that has not been our experience. In fact, investing is like, a test match of 10 years. But people want to invest like a movie of 3 hours. So, that's the whole problem. So that's why they look at it more like a movie rather than as a 10-year test match. So what happens is they don't get the returns. So that is why I think it is very important to follow strategies which actually can benefit people if they don't want to watch a test match for 10 years but want to come out in 3 years or 5 years, then also they should get a good experience. And that has been our clear focus, because while I would want everyone to stay in a test match for 10 years, everyone doesn't want to watch for 10 years and they want to come out in 5 years or 3 years. Problems will start happening when people want to come out in 1 year. And that is the problem which also I see. And that is a challenge if you ask me. So in 2018 was, I would say, one of the most interesting years actually, because in January when we had the meeting, the small cap boom was at its peak. And, no amount of convincing people in 2018 January that small caps was very, very aggressively valued and had huge risks. And in 2017 second half, almost everyone used to tell me, I want to do SIP for 20 years. And I used to tell them, then small cap SIP is fine, mid cap SIP is fine. But now, after 3 years, people have started to ask me, what do I do with the small cap SIP I have started in 2017? The reality is that in 2017 second half, people got sucked with what Vetri mentioned as to what happened between 2014 and 17. And today all those people are asking the reverse question at this point of time. Should I not be in the top 10 stocks now? And that question is continuously being faced. So in 2018, despite the market conditions of that moment, we actually stayed away from recommending equity. We actually recommended balanced advantage and credit risk at that point of time. Of course, it is only in our credit risk you would have had a good experience. But the fact was we knew what we had invested in, so that was the clarity. And I believe that it was one of the best calls that you could have ever given in 2018, because what people did in 2018 January was invest in small and mid caps. And if you looked at the 2-year returns today, you'll see where you are. And it was a miserable experience for people who invested in 2018 January in small and mid caps. In 2019 January, the situation was very different, because at least small caps and mid caps had delivered huge negative experience. And our view was that, there is clear case for asset allocation, because at the end of the day, debt was very, very attractive. And the reality is that, it's very interesting that people don't believe in debt as much as they should. And I find it very strange, because debt has been the most evergreen asset class in all other parts of the world in the last 40 years. And in India, people are not willing to look at debt. and that I find the most interesting, because in my opinion, without debt, there is no investing. And we recommended, and if you look at even within our schemes, if I look at a product like Balanced Advantage Fund or Equity and Debt Fund, if you decompose the returns that have been delivered in the last 2 years, debt had a huge role to play in the returns that have been generated in these products. But if I told all of you that I'm going to invest in debt, people wouldn't have been happy. But clearly we changed our mind and started recommending SIPs, because SIPs had this great problem of averaging market upward, and that problem has clearly hurt people in small caps and mid caps. Luckily, on the day before the budget, clearly you have given me the call to talk about the next decade, and I think that's very interesting, because and not the next 1 year. And the call to give what will happen in the next decade is very, very easy actually. For 10 years, the central banks actually managed to bring down interest rates and ensure that the volatility of the equity market is low. And that phase is over. If you look at what has happened in the interest rates in Japan or Germany, or even to an extent in US. And because of that, I believe that the central bank's capability to reduce volatility in the next 10 years is going to be much, much lower than what you saw in the last 10 years. And you can clearly see it if you look at 1999 to 2009, the average returns of equity were very high. But the volatility was much higher because central banks were not focused on reducing volatility. 2009 to 19, if you looked at it, central banks were focused on reducing volatility. So the returns came down to 10%, but the volatility came down. In fact, in Indian large caps after 2011, equity markets have never gone down more than in a big way, large caps. And that is mainly because I would say central banks across the world don't want markets to fall, but there is now no ammunition left with them. They have fired all their Brahmastras with the exception of US, which still has a few Brahmastras left. All the other central banks have fired all their Brahmastras. So I think next 10 years is going to be much, much more volatile than the last 10 years. And what do you do when you are actually in a much more volatile market for the next 10 years? See, clearly if you look at it, you are in a situation where you will have to embrace asset allocation, because asset allocation is the only way you can manage volatility in the next 10 years. Even if you look at what has happened from January onwards in equity market, it's a taste of the next 10 years. You have had a problem in China. Before that, you had some other problem in Iran. So I think you have had a situation, I would say, that the volatility parts of the market has started. And I believe the next 10 years are going to be so volatile that any asset allocation strategy is going to give you a much better investor experience over the next 10 years than the last 10 years. And interestingly, the last 10 years itself, asset allocation strategies gave you a good experience. So I can imagine why did the last 10 years it gave good experience? Because the asset classes all gave moderate returns. Because of that, it gave a good experience. On the other hand, the next 10 years, the experience is going to be better because of very high volatility relative to the last 10 years. So I think that is very clear, and that is one thing which is going to clearly shape up at this point of time. And I believe that one should invest in equities, but I am a clear believer if you're going to have a very volatile period, you're going to invest it through asset allocation. And when we were actually looking at product strategies for the next 10 years, about 6 months back, we realized that this 3-year SIP and 5-year SIP is not the way to look at SIPs. And when we looked at that data in August, September 2019, we saw that the 3-year and 5-year SIPs on small cap and mid cap had given such disastrous numbers that we said that actually we should package the SIP actually as a 10-year product. And that is how our sales team actually came up with this entire Freedom SIP campaign, because we felt that once you package the SIP into a 10-year product, you're going to create a great goal-oriented product for the next decade. And that is how we came up with this entire Freedom SIP campaign, which we have been pursuing as the SIP product of the next decade. And all of you know the experiences of the 3-year and 5-year SIPs, which you have already seen. And that is why I believe that there is going to be a clear benefit out of choosing a 10-year goal-based SIP over a 3-year SIP kind of structure, which many people had tried in 2017. And the negatives of that has already started to show up in many people's thought process. And so I would say, if you have to look at it, in this presentation of decadal ideas, I would say decadal SIP is the most important idea that we have. It is, I agree, an idea which is SIP is an old idea, but decadal SIP is going to give you a superb experience because of the volatility which we expect to see over the next 10 years. And I think you can't get a better experience than what you will get in a decadal SIP. And while Sunil did talk about 10-year returns on all the categories being the same, it is if people, everyone enjoyed showing 10-year SIP returns till 2018 December. The reason being, when you started showing all the investments that you made in 2008, it showed superb data. So now if you start showing 10-year SIP returns, the returns start coming down because there are no installments in 2008 which form in the 10-year SIP data. So what I believe is that it is very critical that SIPs have to come during bear markets as in when they arise in the next 10 years. And that is going to be the test of this industry. And I would say that I would want the SIPs in the midst of every bear market. 2019, June, July, August, September showed that all of you collected SIP money during that tough phase. And it is because of the SIP money that you collected in that tough phase that the investor is happy. I would again recommend that if people are over allocated in equity, it is a situation where people should go back to a normal allocation so that they have the ability to invest in SIPs during every correction. It's very critical that they have the money to invest in SIPs in every correction. If you look at 2018 and 19, both September, October of 2018 and July, August, September of 2019 showed that every year there is a correction period. And in that correction period, whatever money you collected at SIPs, you made money. Similarly, whatever money you had in categories like balanced advantage and asset allocation in this period, they were the superb experience they gave. So it's very important that you focus on it at this point of time. I believe that, decadal SIP will be the most important investment idea for all people. Unfortunately, the second most important idea after Freedom decadal SIP is accrual investing. Sadly, we are standing here lonely here. And in my investing career, as was committed just before as an introduction, I have always seen that, when I am a lonely investor, the experience has been much greater. So when I grew up in 80s in Chennai, equity investing was not a favorite asset class for most people. So in 80s, when I took up equity investing as my, as what I would call as my vocation, and moved into stockbroking and later into equity fund management, it was a lonely vocation. And it has helped me a lot in my career. Similarly, I believe at this point of time, accrual investing, it looks like ICICI Mutual Fund is lonely. But if you are lonely, you're going to make mega money. Because it is just too important that today people believe that in an asset class, equity is more safer than debt, which is one of the most irrational statements I've ever seen based on all the degrees that I have studied. So I believe that the second most important asset class for the next 10 years will be accrual. And if you get around to starting to sell accrual investing at this point of time, you would have achieved one of the most important things from an investing point of view. Why is accrual investing very important? Because I believe debt is a great asset class. Because in my opinion, a steady player like Rahul Dravid achieved a lot for Indian cricket. And in my opinion, there is a clear requirement for a steady asset class in every investor's portfolio. And the kind of products that have been created, you don't need to choose only accrual in the credit risk variety. There are other varieties like medium term, corporate bond, ultra short, short term, etc. You have a wide variety of products, and I believe that entire basket of products is something which one cannot ignore. And in my reading, when I look at the whole market, I find that, if 120 lakh crores is in banks, and people are very happy in the mutual fund space to look at 12 lakh crores. So why is it people are willing to look at only 1/10 of the potential business? And I believe that is a problem. I believe that when people show mutual fund as a percentage of GDP, people ignore that debt as a percentage of GDP is very high in all the other countries. And I believe that it is going to be in India. Whether it is going to be lonely and only ICICI Mutual Fund is going to talk in front of you and talk about debt, or all others are going to join and make it a great asset class, is something which is there for you to see. Because at the end of the day, equity is a more volatile asset class. It is suited for SIPs. It is suited for asset allocation. We have not seen a long correction in large caps. We have seen it in small caps. You know the burden of these corrections. And that is why debt becomes a great asset class. And every indicator of valuation we use at this point of time tells us that large caps don't look cheap. And at all-time high, I have a framework which says that at all-time high of any asset class, like large caps, I believe that when I get a gathering of 500 IFAs, I'm always cautious on any at any all-time high. I only recommend asset allocation. I don't recommend that asset class, because today it's not that mid caps is at all-time high, small caps is at all-time high. It is only large caps which is at all-time high. And that's why you have to be more careful in large caps today than you are in the other asset classes. And whereas in accrual is at all-time low, because you have a repo rate which is very, very low. You have, on the other hand, all the term premiums or all the rates of interest we get when we invest in any debt other than 3-month AAA, you are getting good rates. And therefore, the opportunity to invest at all-time low, because the spreads are highest at this point of time, is being missed. And, we just show this kind of spread of the gap between the repo rate and the yield to maturity of the different products. That product is showing that something is at all-time low. And when something is at all-time low, my model tells me that you can't ignore any asset class at all-time low. And any asset class at all-time high, you can't ignore the risk. That's how we look at it. The last, which I think is today an annual ritual for me to talk at big events, is the need to adopt technology. All of you have adopted WhatsApp, but beyond WhatsApp, there is need to adopt technology. I find, the status of what has happened to Kodak or Nokia or Yahoo. I believe that many of you have moved forward, but I think the embrace of technology that you have to do has to be complete, and it has to be much more forthright. I believe this problem is a bigger problem in North India, much smaller problem in South India. But considering the level of awareness of technology in South India, the level of impact that you can do by focusing on technology is much, much higher. We have created a package which allows us to use technology in an efficient way. Of course, you can use other industry platforms like MF Utility as well. But I believe that if you ask me, technology is the most important way to scale up business. Because whether it is for the mutual fund industry, whether it is for the telecom industry, whether it is for other industries, margin reductions is a way of life. And therefore, technology is the only way in which we can handle more and more volumes and maintain our absolute profit growth. And that is clearly, I don't think I can talk much about budget one day before, because I also have no grip this time given the kind of situation we are in. But if I had to look at it for the next 10 years, it's simple for me. Embrace anything to do with volatility, which is asset allocation and long-term SIPs. Do not ignore debt, particularly the role of accrual. Do not ignore technology and any way in which it can improve your productivity. And from next year, my request is try to do the event post-budget. You will get a one-year view, which will be better. This year, what I have stated is not going to change for the entire decade, because the embrace of technology, the embrace of volatility through SIPs and asset allocation, the embrace of debt, everything is not going to change for the next 10 years. So since we will go back to our yearly views, I would request you to do it post-budget, because it's much better for me to communicate a year view at that point of time. Thank you very much.